Good morning, traders, and happy Monday. Welcome back to today's daily analysis for the 9th September 2024. Starting off with the dollar index, last week it weakened due to the lower than expected non farm payrolls for August, with the US dollar next dropping to 100.56 before recovering slightly. Despite the data, the likelihood of a 50 basis point interest rate cuts by the Fed Reserve in September remains high. The officials may not agree just yet. The market might be overestimating the need for aggressive rate cuts, but the 25 basis point cut seems certain. The recent weak labor market data has increased the chances of a more significant rate cuts, possibly around 35 to 40 basis point when the Fed meets on the September 18. The dollar decline could benefit low interest and the pro-cyclical currencies. Technically, the US dollar is bearish, with the RSI indicating negative momentum. The key resistance levels are at 101.52 and 101.92, while the support is at 100.89. If the dollar drops further, the psychological barrier of 100 could be tested, with a potential low of 99.57 or even 97.73. Next, for the WTI crude oil, the prices dropped sharply, hitting a new low of $66.72 for the year, largely due to the weak communications with the OPEC Plus. While the OPEC Plus postponed its planned production increase for November and October, the market has expected a more arrested measures to support prices. Libya's presumption of the oil production and concerns about the demand from the US and China also pressured the prices. WTI crude oil fell below $70 per barrel, but the production delay and increase of the crude inventories may limit further declines. China's weak economic data, including the South Manufacturing PMI, contributed to the drop. However, positive signals from OPEC Plus could provide some support. Over the past 2 weeks, the crude oil prices may have fallen more than 15%, from a high of 78.77 to 66.72. Technically, the prices may dip slightly more before finding support for a rebound. The 14-day RSI at 32.75 suggests a possible recovery. If the prices rise back above $70, the resistance level are at 72.10 and 73.66, with a potential target of $75.44. On the downside, watch for 66.72 as a key support, followed by $66.20. And then lastly, for the gold prices, initially faced bearish pressure last week, but recovered to $2,500, benefiting from the lower US Treasury yields. The direction for the gold would likely depend on the upcoming US inflation data. Before the weekend, gold prices retreated from the near record high due to the mixed US employment data, which raised questions about the extent of the Fed recent rate cuts. The August non-farm payrolls rose by 142,000, below the expected of the 160,000. With July's data also revised, if the Fed rate cuts further, the gold prices could rise, potentially reaching $2,700. However, even with the gold near historical high, significant non-farm payrolls improvements are necessary for the price drops. The current price trend may prompt trend flowers to sell, despite the gold high level. Technically, the gold prices fell sharply high of 2,529.5, dropping below the 200 key support level and losing short-term moving average support. The 14-day RSI is at 54.50 and MACD and MA indicator show bearish signals. The recent support is at 2,487. If breached, 2,470 and 2,461.3 could be next. On the upside, Resistance is at 2506.30, with potential targets at 2530, 31.70, and 2650, which is the upper channel line. And that is all for today's daily analysis. Thank you for watching and have a nice day.